Hey guys, Tanya again from Essential Facts. Let's talk about how payments are calculated today. Um, I'm going to talk mainly how they're calculated with credit cards because people always want to know how their payment is calculated with credit cards. That was like a major question that people would always ask. How is my payment calculated? So here's the thing. We're gonna go over with that. I'm gonna touch a little bit on, just with a loan. Like I said, there's so many different types of loans. As you know, I stated in one of my other videos. But as far as credit card payments are calculated, it just depends on what your balance is each month, obviously. I'm sure, we all know that part right there. That is based off of your balance. Um, Press like, press subscribe. This is Essential Facts. Again, love giving you the information that people don't know behind the scenes. If you have any questions, again, do it in the comments. Let me know. I'll do my best answering your questions. If I don't know again, I will get back to you. So let's get into it. So payments are calculated not just on the balance, but it's just what the average balance was for the billing cycle. So your billing cycle can have 28 days in it. It can have 30 days in it, 29, 31. It depends on how many days you're in the month and when your due date is. So if you have a payment that's due, on the second of the month, in December, and is due the second of the month, in January. Well, I don't want to do December and January. Let's say you have a payment due on the second of the month in September, and there's a payment due on the second of the month in October. Well, September has 30 days in it, October has 31 days in it. So that right there is going to either, depending on, how many days are in the month, is either going to add like extra or less of, a days of interest or whatever. So, and then you have February, which is normally 28 days, unless it's a leap year. Then that's like 2 days you're dealing with where you might have, 32 days worth of interest and, or 31 days of interest. But nonetheless, so what happens with most banks, how they calculate your credit card payment, is that they take, again, the average balance, whatever your interest rate is, they take that balance, they multiply it by the interest rate, they divide it by 365 days of the year. Some banks might use 360, but most will use 365 days um, of the year. So use that number 365. And then they multiply it by how many days are in the billing cycle. And that right there tells you what your interest is. So they take whatever percentage they want to use for the payment based off of your balance. It could be 2% of the balance, just a straight payment without the interest. It could be 2% of the balance. It could be 3% of the balance. It could be 5% of the balance. It just all depends on the bank. And they take that dollar amount, obviously, they add the interest to it that was calculated. If there is a late fee, they will add that late fee onto it. Now, that all three of those total out, that will give you your monthly payment for, that's due, whenever that payment is due. Banks what they used to do, they used to then add the um, the late fee. Sometimes it wasn't added on in that statement. They would just add on to the balance of the account. But a lot of times when that happened was they didn't get if the person was written off as an uncollectible debt, they never got any of the money anyway. So they get the money up front now, the late fee up front. But for many years they've been doing it like that, really, where they just add that late fee in there up front. So again, like I said, when you have your mortgages, it's a percentage. So, just for example's sake, let's just say your payment is, um, let's say your payment is $1,000 a month, right? And I don't know, maybe the bank, I don't know, they charge 1.8% um, of the amount, whatever it is, the payment. It's probably be more like 2%, 3% of the payment is what they're going to charge for the late fee. And they don't add, like, here's the thing with a mortgage, they're not going to add that payment. I mean, that they're not going to add a late fee onto the regular payment you pay each month. And see, and this is where people I would get all the time with mortgages is that people will say, well, I was past due, I made my payment, and I was told by whoever that if I make this payment, that I'm up to date. So the way mortgages work, they don't work. Remember, you are on a set term that you are an amortized term loan with a mortgage, a first mortgage. I'm not talking about your home equity lines or your home equity loans, not those. Those are something completely different how those are calculated. But with your first mortgage, whenever you make a payment on the account or they're billing you, they're not going to say, you look at that statement, they're going to show you that late fee. But if you go online, it may or may not show you the late fee. You have to click a button. I just every bank's site is set up differently, but it may or may not show you that late fee up front. You may have to click on a few things. And you're thinking that, oh, they just put the late fee, they just add it to the balance on the back end of the balance. No, it's not added to the back end of the balance. It's going to keep billing each month that you made, that late fee wasn't paid. So that you just made the regular payment on the account. So now you have all these late fees building up, and you try to figure out why are these late fees building up? Because I'm making the payment on the account. So when you have a mortgage, you have to, when you make the payment, you have to specify that this is the payment is being made for the regular principal and interest payment. And then you're making another payment where you're applying it. This is for the late fee. Now, if you go inside of a branch or if you call the bank and they do the payment over the phone, however they want to do it, you just tell them, like, hey, I'm paying, this is the payment I'm paying, and then I need you to apply this other payment, whatever the dollar amount is for the late fee, apply this to the late fee. Now, again, like I said, a lot of times when you're online, it will let you do that you're applying that late fee payment that's being applied separately. So a lot of people don't understand that and always have like a lot of problems with that. And then, then the back office, they have to go back and fix it, or a manager has to fix it, because the payment wasn't applied accordingly. So again, like I said, when you have a payment that's due on the account, and now and you're getting that late payment in there, you want to make sure with a mortgage that you're making a payment, your regular payment, you're going to make your other payment and make another payment, and you're going to say, I want you to apply it to the late fee or late fees or whatever. Again, with the credit cards, it doesn't matter because it's very blatant. They just add the total amount into this is what your payment is due for this month. Your payment is $100. Interest is $20. The late fee is $30. So your payment due is $150 now. And if you don't pay that full amount, then you made a partial payment on the account. And then now you're going to be past due if you don't cover that partial payment you made by the next due date. Because that little bit amount right there will cause you to fall 30 days behind. So just be very cognizant of that. when it comes to payments. Um, let's see what else I want to hit here. Some banks now they will have you pay the interest up front with certain accounts. Where they'll add that interest in there versus adding the interest into the full balance. They might add that interest, up front as part of the payment for you to make. Um, how much payment you make on the account determines a few things. So if you pay in full each month, but you hardly use your card, you're not valuable to that bank. You can be late one time, get a late charge, and then get some interest calculated. You call into the bank on your credit card. Oh, I pay my bill every month. I can't believe you charged me a late fee. Can you waive the finance charges? You guess what the bank is going to say? Nope. Most of the time they're going to say nope because they don't really have a reason to close your account down because you're using it periodically throughout the year or maybe once out of the year or whatever. So they're not going to necessarily close you down. But when you want them to waive it because you were late that one time and you never been late before and you paid in full, they're not making any money off of you. So when you say, I'm mad, go ahead and close my account down, they're going to say, okay, destroy the card. We'll close your account down. You'll receive a letter in the mail in the next 7 to 10 days. Now, if you pay your balance in full every month because you use the card every single month. They're not making any interest off of you, but they are making interest. I mean, they are making money off of you in other ways because whenever you swipe that card or whenever the merchant swipes the card, they're benefiting from it. So you may not pay their typical interest, but you use the card every month, so they're getting money off of you that way, by the merchant. If you make minimal payments on the account and you um, call in for an increase on the credit line, and I believe we discussed this before on another video, and you make minimal payments on the account and you have a high balance, they're not going to do anything for you either. They're making that interest off of you. They're fine with that. They're making some money off of you because sometimes that interest might be just as much as the what the actual minimum payment is, not including the interest. It might be the same, so they don't care. They're making money out of you, and they have a lot of customers that are like that. So you're valuable to them, but at the same time, if something were to go left where they feel like that you're becoming a risk, they will take action. But a lot of times they don't mind if you're making a minimum payment, making just above a minimum payment. They don't really care because they're making a lot of money of interest off of you. It's not that big of a deal. Again, if you have the ability to pay more always. Always pay more. Because banks, they do really love seeing that you have the ability to roll a balance where they can make interest off of you, but yet you can still make a pretty decent payment each month. You're the ideal candidate for them. You are the ideal candidate, ideal person, ideal car holder for them because you make more than the minimum payment, but you don't pay it off. You use the card each month, so they're making money. It's a win-win-win for them all the way. So you're just like the ideal car holder. So it's kind of like really all I have with just talk about how payments are calculated with credit cards. Um, and how if you receive like a late fee or something like that, or like how the interest like with the credit cards and a mortgage, your first mortgage. But if you have any questions, again, let me know. To me what you think. Tell me some situations that you have encountered with your bank or credit card company, and yeah, we'll dive into it and see what we can come up with an answer or a resolution about it. Again, this is Essential Facts. My name is Tanya, and as always, you guys have a great day. Don't forget to hit subscribe and like. Ciao.